In 1980, the Hunt brothers tried to corner the silver market. They failed because their squeeze was driven by greed, and the government simply changed the rules to stop them. But in 2025, we are facing a squeeze that is not caused by greed. It is caused by physics, and you cannot change the rules of physics. Last week, while the world watched interest rates, Samsung SDI quietly confirmed a technology that breaks the global supply chain. They released the specifications for a solid-state battery that replaces the flammable liquid inside electric cars with a new, stable material. That material is silver, and they don't need a little bit of it. They need grams per cell. To the average investor, this sounds like good news. But to anyone who knows the math, it is an extinction signal, because this new demand is hitting the market at the exact moment our safety net has disappeared. For the last 5 years, the global economy has been protected by a ghost inventory, a hidden buffer of 1.1 billion ounces that kept prices low despite a structural deficit. That buffer hit zero this week. We have stripped the vaults in London, we have drained the reserves in Shanghai, and now precisely when the cupboards are bare, Samsung has arrived to demand more metal than the mining industry can produce. We are no longer looking at a trade. We are looking at a mathematical wall. The ghost inventory is gone. The silver carbon era has begun, and the price on your screen is about to collide with reality. Stage 1, the illusion of abundance. To understand why the crash hasn't happened yet, you have to look at the invisible architecture of the market. For the last 5 years, the world has been operating under an illusion. The illusion was that we had enough silver, and on the surface, the illusion held. You could go to a dealer and buy a coin. Apple could buy silver for its iPhones. Solar companies could secure their contracts. Prices remained stable. Volatility remained low. But beneath the surface, the foundation was rotting away. Since 2020, the global economy has consumed more silver than the mining industry could produce. In 2021, the deficit was 50 million ounces. The market shrugged. In 2022, it grew to 238 million ounces. The market ignored it. By 2024, the cumulative deficit, the amount of silver we burned beyond what we mined, crossed 800 million ounces. In a normal market, this would have triggered a price explosion 3 years ago. So, why didn't it? Because of the ghost inventory. This was a massive unallocated stockpile of roughly 1.1 billion ounces that had been built up over decades of surplus. It sat in vaults in London. It sat in private stockpiles in Switzerland. It sat in the Shanghai Gold Exchange. This stockpile acted as a buffer. Every time the miners fell short, the ghost inventory filled the gap. It allowed industrial users to sleep at night. It allowed the banks to pretend that supply and demand were balanced. It was the just-in-time delivery system, applied to a finite resource. But the problem with a buffer is that it eventually runs out. And that is exactly what happened in late 2025. The visible inventories in the COMEX registered vaults have collapsed to lows we haven't seen in a decade. The float in London has been drained by ETFs. And most critically, the Shanghai Gold Exchange, the heartbeat of the industrial market, has seen its reserves evaporate. We have spent 5 years eating our seed corn. We treated a finite strategic asset like it was infinite. And now the illusion of abundance is gone. The buffer is at zero, which means the next ounce of demand does not come from a vault. It has to come from a mine. And as you are about to see, the mines are already tapped out. This is the stage 1 trap. We have stripped the system of its defenses right before the attack begins. Because while we were draining the ghost inventory to build standard solar panels, the engineers at Samsung were finalizing a design that would make those solar panels look like a rounding error. The buffer is gone, and the silver carbon anode has just arrived. Stage 2, the new variable. This brings us to the second variable, the one that turns a supply deficit into an extinction event. To understand the trap we are walking into, you have to understand why the electric vehicle revolution stalled in 2024. The media told you it was because of interest rates. They told you it was because consumers didn't want the cars. That is false. The revolution stalled because of a single, microscopic flaw in the laws of physics. It is called the Dendrite. For 30 years, every lithium-ion battery has faced the same fatal limitation. When you force energy into the battery quickly, which you need to do for fast charging, the lithium ions don't settle evenly. They build up on the anode, like jagged stalagmites in a cave. These are the dendrites. As they grow, they pierce the separator wall inside the battery. They bridge the gap between the anode and the cathode. And when that bridge connects, the battery shorts. It heats up. It catches fire. This is not a manufacturing error. It is a fundamental property of lithium. And for a decade, it has been the great wall stopping the auto industry. It is the reason your EV takes 45 minutes to charge. You have to trickle the energy in slowly to prevent the dendrites from growing. Toyota, Volkswagen, and Samsung have spent billions trying to break through this wall. And in late 2025, Samsung SDI finally did. But the solution they found is the nightmare scenario for the commodities market. Samsung discovered that if you coat the anode with a specific silver-carbon composite, the dendrites stop growing. The silver acts as a host. It doesn't just sit there. It chemically dissolves the lithium ions, distributing them perfectly flat. It allows for a battery that charges in 9 minutes, a battery that lasts 900 miles, a battery that cannot catch fire. It is the solid-state holy grail. But here's the detail that the engineering papers mention, but the financial papers ignore. To make this chemistry work, you cannot use silver the way we use it in an iPhone. In your phone, silver is a spice. It is a trace element used for conductivity, a fraction of a gram. If the price of silver goes to $100, Apple doesn't care. But in the Samsung solid-state cell, silver is not a spice. It is the active material. It is the fuel. And the amount required is staggering. The technical specifications point to a loading of roughly 5 grams of pure silver for every kilogram of anode material. Well, let's translate that into reality. A Ford F-150 Lightning has a massive battery pack. Under this new chemistry, that single truck could require up to 500 grams of silver. That is half a kilogram. That is 16 troy ounces of silver in one vehicle. Now, do the multiplication. Global car production is roughly 90 million units a year. If just 20% of the global fleet switches to this technology, just the premium cars, just the trucks, we are looking at new annual demand of over 100 million ounces. That is a conservative estimate. If adoption hits 50%, the number jumps to 250 million ounces. That is the equivalent of a second solar industry appearing out of thin air overnight. And this demand is inelastic. This is the most dangerous word in economics. It means Samsung cannot buy less just because the price goes up. They cannot thrift the silver out. If they reduce the silver loading, the dendrites return. If the dendrites return, the car explodes. The silver is structural. It is non-negotiable. Toyota cannot sell a car that is mostly safe. They are hostage to the periodic table. So we have a new variable, a demand source that measures in the hundreds of millions of ounces, a technology that cannot function without it, and a buyer, the global auto industry, that has deeper pockets than any bullion bank in existence. This variable is hitting the market right now. Factories are breaking ground in Korea and Kentucky today, and it is colliding with the reality we discussed in Stage 1. The buffer is gone. The ghost inventory is 0. Stage 3, the extinction equation. So, we have established the trap. The buffer is gone. The new demand is inelastic and massive. Now we must look at the final variable in this equation, the supply. If you open a standard economics textbook, it will tell you that when demand rises, supply rises to meet it. It is the most basic rule of capitalism. If people want more silver, the miners will simply dig more silver. But in the geology of silver, the rules of capitalism do not apply. We are governed by the rules of depletion. There is a number you need to memorize, 830 million ounces. That is roughly the global mining production of silver in a single year. That is the ceiling. For the last decade, despite the price going up, despite new technology, despite billions in investment, that number has refused to budge. In fact, it is trending down. Why? Because the easy silver is gone. We mined it in the 1900s. We are now processing rocks that contain mere grams of metal per ton. We are literally crushing mountains to find dust. Now, let's solve the equation for the year 2026. Start with our ceiling, 830 million ounces. First, subtract the legacy demand. Jewelry, silverware, electronics, and traditional industry. This is a consistent baseline of roughly 600 million ounces. That leaves us with 230 million ounces of free supply. 10 years ago, that was plenty. But then came the photovoltaic solar boom. In 2023, the solar industry consumed roughly 190 million ounces. In 2024, as panel efficiency increased and China ramped up production, that number pushed past 200 million. Do the math. 230 million available, minus 200 million for solar. We have 30 million ounces left for the entire rest of the world to fight over. The margin of error is effectively 0. And this is the moment Samsung walks into the room. Remember the math from Stage 2? If the solid-state battery captures just a fraction of the EV market, it requires 100 million ounces of new inelastic demand. We only have 30 million left. The moment the first Samsung factory reaches full capacity, the equation turns negative. We are not talking about a tight market. We are talking about a physical deficit of 70 million ounces per year. And here is the terrifying part for the industrial users. The miners cannot save you. In the software world, if you need more code, you hire more developers. In the mining world, if you need more silver, you have to find a deposit, permit it, build infrastructure, and dig. The average lead time from discovery to production is now 15 years. If the price of silver goes to $500 an ounce tomorrow, the supply of silver will not increase by a single ounce until the late 2030s. This is the inelasticity of supply meeting the inelasticity of demand. Samsung must buy the silver to build the cars. The miners cannot produce more silver to sell them. When an unstoppable force meets an immovable object, something has to break. Usually it's the price. But in this specific scenario, it's the entire structure of the market. We are approaching a specific date on the calendar. We call it the Allocation event. This is the day when a major industrial user, maybe Tesla, maybe Apple, maybe a defense contractor, calls their bullion bank to place an order for physical delivery. And the bank says, "We can't fill it. Not, it will cost more, but we do not have the metal." When that phone call happens, the spot price of silver becomes a meaningless number on a screen. The real price becomes whatever the highest bidder is willing to pay to keep their factory open. This is not speculation. This is arithmetic. 830 million ounces of supply, minus 600 million legacy, minus 200 million solar, minus 100 million Samsung. The result is a negative number. And you cannot run a global economy on a negative number, the equation of inevitability. So, what is the verdict? For 40 years, silver has been treated as a paper asset. It has been traded by algorithms, suppressed by futures contracts, and ignored by the mainstream financial press. It was just a line on a chart, detached from reality. Those days are over. Physics has re-entered the chat. The ghost inventory that allowed us to pretend supply was infinite is gone. The geological reality that supply is capped is now undeniably clear. And the technological reality of the Samsung battery has turned silver from a precious metal into a strategic energy fuel. We are not looking at a bull market. A bull market is when an asset class becomes popular. We are looking at a systemic reset. A reset is what happens when the paper claims on an asset exceed the physical atoms available to satisfy them. When the music stops, and it is stopping right now, there will be two types of investors. Those who own paper promises of silver, and those who hold the physical metal. The auto industry cannot use paper silver. The solar industry cannot use paper silver. They will strip the physical market bare, leaving the paper speculators holding worthless contracts. The window to position yourself ahead of this reality is closing, not because of hype, not because of fear, but because of the math. The equation is solved. The deficit is here. The rest is just watching the price catch up to the truth. Case closed.